Gold just shattered $5,100 per ounce, a record that shouldn't exist. Silver broke $100 for the first time in history. Platinum hit all-time highs. And here's what your financial advisor isn't telling you. This isn't about gold going up. This is about your dollar collapsing in real time. Analysts are predicting $6,000 gold this year, not because gold is becoming more valuable, but because the dollar is becoming worthless. Trump's erratic tariff threats just triggered a permanent rupture in global confidence. Central banks are dumping dollars for the 14th straight month. And if you're holding cash, a 401k, or any dollar-denominated assets, you're about to lose purchasing power so fast it'll make 2008 look like a minor correction. Let me show you the currency crisis unfolding right now that the media is calling a safe haven rally. Let's start with what just happened, because the numbers tell a story of systemic failure. The historic surge Monday morning, spot gold surged to a record high above $5,100 an ounce. It touched an all-time peak of $5,110.50 before settling at $5,089.78, up 2.2% in a single day. U.S. gold futures for February delivery gained the same amount, hitting $5,086.30 per ounce. Gold has already risen more than 18% this year. We're in January. That's 18% in less than a month. The 2025 explosion. The metal soared 64% in 2025, its biggest annual gain since 1979. Let me put that in context. In 1979, gold surged during the Iranian Revolution and the Soviet invasion of Afghanistan. The world was in crisis, inflation was rampant, the dollar was collapsing. We just had the same level of gold performance in peacetime in the world's largest economy. It's not just gold. Spot silver advanced 4.8% to $107.90 after hitting a record of $109.44. Silver climbed above $100 for the first time ever on Friday, building on its 147% rise last year. Spot platinum climbed 3.4% to $2,861.91 per ounce after hitting a record high of $2,891.60. Spot palladium rose 2.5% to $2,060.70, touching a more than 3-year high. Every precious metal simultaneously hitting record highs isn't a coincidence. It's a coordinated flight from paper currencies into physical assets. What safe haven demand really means. The media calls this safe haven demand. That's a euphemism. What it actually means, investors globally are losing confidence in the dollar, in government bonds, in traditional financial assets. They're buying gold, a non-productive asset that generates no income, because they believe it will hold value better than cash. When rational investors choose an asset that produces nothing over assets that produce income, they're not being optimistic about gold. They're being pessimistic about everything else. The analyst quote that reveals everything. Kyle Rodder, senior market analyst at Capital.com, explained the latest catalyst. This is effectively a crisis of confidence in the U.S. administration and U.S. assets. That was set off by some of the erratic decision-making from the Trump administration last week. Read that again. A crisis of confidence in U.S. assets, not gold strength, dollar weakness, Rodder continued. This Trump administration has caused a permanent rupture in the way things are done, and so now everyone's kind of running to gold as the only alternative. Permanent rupture, the only alternative. This is an analyst telling you the system is breaking. Let's talk about what specifically triggered this gold surge, because Trump's actions last week destroyed decades of dollar credibility in days. The Greenland tariff threat. Trump threatened to impose tariffs on European allies as leverage to seize Greenland. Let me repeat that. He threatened America's closest allies with economic warfare to acquire territory. Then he abruptly stepped back on Wednesday. The threat was withdrawn, but the damage was done. You can't threaten allies with economic destruction and then pretend everything is fine. The Canada 100% tariff over the weekend. Trump said he would impose a 100% tariff on Canada if it followed through on a trade deal with China. Canada, America's largest trading partner, the country with the longest undefended border in the world, the closest U.S. ally. Trump threatened to double the price of every Canadian import because of a trade deal with a third country. The France 200% tariff threat. Trump threatened to hit French wines and champagnes with 200% tariffs in an apparent effort to pressure French President Emmanuel Macron into joining his Board of Peace initiative. Think about that. Tariffs aren't being used for economic policy. They're being used to coerce foreign leaders into joining Trump's personal diplomatic projects. The pattern of erratic decision-making: threaten Greenland tariffs, withdraw them; threaten Canada with 100% tariffs, threaten France with 200% tariffs on wine. This isn't strategy, this is chaos. And when the world's reserve currency is controlled by a government making erratic, unpredictable decisions, rational actors flee to assets that government can't devalue: the dollar as a weapon. Here's what Trump revealed: the U.S. is willing to weaponize the dollar and the American market to achieve non-economic goals. If you're a foreign government, a foreign investor, foreign company, you just learned that holding dollar assets means exposure to arbitrary, politically motivated policy changes. Why would you keep your wealth in an asset that can be weaponized against you at any moment? You wouldn't, so you buy gold. The Board of Peace controversy: Trump's Board of Peace initiative has raised concerns among observers that it could undermine the United Nations' role as the main global platform for conflict resolution. Trump says it will work with the UN, but the message is clear: the US is creating parallel institutions because it doesn't trust existing ones. This signals a breakdown in the post-World War II international order. And when that order breaks down, the dollar, which derives its value from that order, becomes questionable. The permanent rupture, rather, called it a permanent rupture in the way things are done. You can't unring this bell. Trump demonstrated that US policy is unpredictable, that alliances are transactional, that the dollar can be weaponized arbitrarily. Even if Trump reverses course tomorrow, the precedent is set. Future administrations could do the same. The dollar is now a political weapon, not a neutral store of value. That's why gold is at $5,100, not because gold changed, because the dollar's credibility died. Individual investors buying gold is one thing, but when the world's central banks, the institutions that manage national wealth, are dumping dollars for gold, that's a systemic shift. China's 14th straight month. The document notes that 2025's gold surge was driven by robust central bank purchases, including China's 14th straight month of buying in December. 14th straight month. That's not a hedge, that's a strategy. China is deliberately, systematically reducing dollar exposure and increasing gold reserves. Why central banks buy gold? Central banks hold reserves to stabilize their currency, back international trade, provide confidence in national finances, hedge against dollar devaluation. When China buys gold for 14 straight months, they're saying, we don't trust dollar stability. We're diversifying our national wealth away from US assets. The global pattern: it's not just China. Central banks globally have been net buyers of gold since 2010, but purchases accelerated dramatically in 2022 to 2025. Russia, Turkey, India, Poland, Singapore, and dozens of other countries have increased gold reserves significantly. These aren't coordinated, they're independent decisions by different governments reaching the same conclusion: dollar risk is too high. The record ETF inflows. The document notes record inflows into exchange-traded funds as a driver of gold's 2025 surge. ETFs are how ordinary investors and institutions buy gold exposure. Record inflows mean unprecedented demand from the investment community. This isn't retail panic buying. This is sophisticated investors, hedge funds, pension funds, family offices, systematically increasing gold allocation. The monetary policy easing factor: U.S. monetary policy easing, meaning lower interest rates and continued money printing, also drove gold demand in 2025. When interest rates are low, the opportunity cost of holding gold, which pays no interest, decreases. When the Fed prints money, each dollar becomes worth less, making gold more attractive. The Fed has signaled it will continue easing. That's more money printing. That's more dollar devaluation. That's more gold demand. The Fed meeting this week. The document mentions markets are on alert ahead of this week's Federal Reserve meeting. If the Fed signals continued easing, gold will surge higher. If the Fed signals rate increases to defend the dollar, markets will panic because higher rates could crash the economy. The Fed is trapped. Either choice accelerates gold demand. The dollar index collapsed. A rising yen dragged the dollar broadly lower on Monday. Investors are cutting dollar positions. A weaker dollar makes gold more affordable. for holders of other currencies, which increases demand and pushes prices higher. But here's the vicious cycle. Gold surges because the dollar weakens. The dollar weakens because confidence erodes. Confidence erodes because of erratic policy. Erratic policy continues. Gold surges more. This is a feedback loop, and it's accelerating. Analysts aren't predicting gold will stabilize. They're predicting it will surge to $6,000 or higher. Let's talk about what that means for your money. The $5,500 baseline forecast, Philip Newman, director at Metals Focus, stated, "We expect further upside for gold. Our current forecast suggests that prices will peak at around $5,500 later this year. That's another 8% increase from current levels. By year-end, gold could be up 25% from today's already record highs." The $6,000 scenario. Other analysts expect gold to climb further towards $6,000 this year on mounting global tensions and strong central bank and retail demand. From today's $5,100, that's a 17.6% increase. Combined with the 18% gain already this year, we're talking about 35 to 40% total returns in a single year. That's not gold becoming more valuable, that's the dollar losing 35 to 40% of its purchasing power relative to real assets. The pullback pattern, Newman added. Periodic pullbacks are likely as investors take profits, but we expect each correction to be short-lived and met with strong buying interest. Translation: every time gold drops, buyers will rush in. The trend is relentlessly upward because underlying fundamentals, dollar devaluation, geopolitical chaos, central bank buying aren't changing. What this means for your savings: if you have $100,000 in a savings account, earning 4% interest, you're making $4,000 per year. But if gold rises another 30% this year, your $100,000 in dollar-denominated savings just lost $30,000 in purchasing power relative to real assets. You're earning 4% while losing 30%. Net result, you're 26% poorer by year-end. What this means for your retirement: most 401ks and IRAs are invested in stocks and bonds, dollar-denominated assets. If the dollar collapses, your retirement savings collapse in real terms, even if the nominal numbers stay the same or increase slightly. $1 million retirement account that loses 30% of its purchasing power is now worth $700,000 in real terms. What this means for your paycheck: you're paid in dollars. If the dollar is losing 30% of its value relative to real assets, your salary is effectively getting cut 30%. Unless your employer gives you a 30% raise, which they won't, you're getting significantly poorer this year despite working the same job. What this means for inflation: gold at $6,000 means the dollar has devalued massively. That devaluation shows up as inflation. Food prices rise, gas prices rise, housing costs rise. Everything priced in dollars becomes more expensive because dollars are worth less. The government will claim inflation is 5 to 7%. Real inflation measured against hard assets like gold will be 30 to 40%. So gold is at $5,100, heading to $6,000, and the dollar is collapsing. What do you actually do as an ordinary citizen? Don't panic buy gold at the peak. The worst thing you can do is panic buy gold at $5,100 after it's already risen 18% this year. If you didn't buy gold below $3,000, buying at $5,100 means you've already missed most of the move. You're buying high, which is the opposite of investment wisdom. Understand what gold ownership actually means. Gold doesn't produce income, it doesn't pay dividends, it doesn't generate cash flow. Owning gold is a bet that fiat currencies will continue devaluing. If you're right, gold preserves purchasing power. If you're wrong, you've held an unproductive asset that could have been invested in income-generating assets. The dollar-cost averaging approach: if you believe gold will hit $6,000, don't buy everything at $5,100. Dollar-cost average: buy a small amount now, buy more if it drops to $4,800. Buy more if it drops to $4,500. This reduces your average purchase price and protects you if there's a correction before the next surge. The allocation question: financial advisors traditionally recommended 5 to 10% of portfolio in gold as a hedge. In the current environment, some analysts suggest 15 to 20%, but that depends entirely on your age. Younger people can take more risk, income stability, Higher income equals less need for safe havens. Existing debt. Pay off high interest debt before buying gold. Risk tolerance. Can you stomach volatility? Physical gold versus paper gold. You can own gold several ways. Physical gold, coins, bars. You control it, but storage and insurance cost money. Liquidity is limited. Gold ETFs, easy to buy and sell, but you're trusting financial institutions. In a true crisis, could ETFs be frozen? Gold mining stocks leverage exposure to gold prices, but company-specific risks. Higher upside, higher downside. The inflation protection strategy, instead of or in addition to buying gold, invest in inflation-resistant assets. Real estate. Physical property tends to hold value when currency devalues. Commodities. Energy, agriculture, metals, things people need regardless of dollar value. International diversification. Assets denominated in other currencies reduce dollar exposure. Productive businesses. Companies that can raise prices with inflation maintain real value. The debt consideration. If you have debt, rising inflation helps you. You borrow dollars when they were worth more. You repay with dollars worth less. Fixed-rate mortgages become incredibly valuable in high inflation environments. Your payment stays the same while your income, hopefully, rises with inflation. Variable rate debt is dangerous. Interest rates could spike if the Fed tries to defend the dollar. The income strategy focuses on increasing your income to match or exceed inflation. Negotiate raises aggressively. Inflation gives you leverage. Develop skills that command higher pay. Start side businesses that can raise prices with inflation. Invest in income-generating assets that adjust for inflation. The time frame reality. Gold hitting $6,000 might happen this year, or it might take 3 years, or it might never happen if confidence in the dollar is somehow restored. Don't make decisions based on short-term predictions. Make decisions based on your long-term financial security, regardless of what gold does. Gold is at $5,100. Silver broke $100. Platinum hit all-time highs. And the financial media is calling this a safe haven rally, as if it's a normal market movement. It's not normal. This is a crisis. What the numbers really tell you. Gold up 64% in 2025. Up another 18% in 3 weeks of 2026. Heading to $6,000, according to analysts. Central banks buying for 14 straight months. Record ETF inflows. Every precious metal surging simultaneously. This isn't investors being optimistic about gold. This is investors fleeing the dollar in terror. The permanent rupture trumps erratic tariff threats, 100% on Canada, 200% on French wine, using tariffs to seize Greenland, revealed that the dollar is now a political weapon. The permanent rupture analyst Kyle Rodder described isn't hyperbole. It's reality. You can't weaponize the world's reserve currency and expect people to keep holding it. Trust, once broken, doesn't return. The Fed's impossible position. The Federal Reserve meets this week. They have no good options. Ease policy, print more money, devalue the dollar further, gold surges more, tighten policy, raise rates, crush the economy, markets panic anyway. They're trapped, and everyone knows it. That's why gold is the only alternative. What this means for you, your savings are losing purchasing power daily. Your paycheck buys less every week. Your retirement account's real value is eroding. The government won't tell you this. The media won't emphasize it. Your financial advisor might not even understand it. But the gold price is screaming it. The dollar is dying. The action timeline. You don't have years to prepare. You have months. Gold at $5,100 today, potentially $6,000 by year end. That's an 18% move that represents 18% purchasing power loss if you're holding dollars. Diversify now, increase income now, reduce dollar exposure now. The uncomfortable truth. Most people won't do anything. They'll read this, feel concerned, and then go back to their normal lives. They'll watch gold hit $6,000, $7,000, maybe higher, while their dollar savings evaporate. They'll wonder why groceries cost twice as much, why their retirement doesn't go as far, why they can't afford what they could afford last year. And they'll blame inflation, blame politicians, blame the economy, without understanding that the currency they trusted to store their wealth was systematically devalued while they did nothing. The bottom line, gold at $5,100, isn't about gold. It's about the dollar. The Trump administration's erratic policies destroyed confidence. Central banks are fleeing. Sophisticated investors are fleeing. The smart money is already gone. The question is, are you going to act while you still have time? Or are you going to watch the number in your bank account stay the same while its real value disappears? Gold just told you the answer. The crisis is here. The permanent rupture happened. What you do next will determine whether you preserve your wealth or watch it evaporate. The clock is ticking, and gold just hit $5,100 to prove it. Still your guy innocent? Don't forget to hit the subscribe button, comment, like, share, and turn on your notification button to receive more financial news and commentaries. See you on the next one.